Today, I want to dive into the fascinating world of value investing and why it's particularly relevant for Indian investors, especially those just starting out. So, what is value investing? Simply put, it's an investment strategy where you look for stocks that are undervalued, essentially buying a dollar for 50 cents. You're searching for companies that have solid fundamentals but are trading at a lower price than their true worth. This approach matters because it encourages a long-term perspective. In a market that often seems driven by trends and hype, value investing teaches us to focus on the underlying value of a company. For Indian investors, this is crucial. With the Indian stock market growing rapidly, there's a wealth of opportunities, but it's easy to get caught up in the excitement and make impulsive decisions. Value investing helps you stay grounded. Take Warren Buffett, for example. He's the poster child for value investing, famously saying, "Price is what you pay, value is what you get." His strategy has led him to become one of the wealthiest individuals in the world. But it's not just Western investors who have thrived using this method. Look at Rakesh Jhunjhunwala, often referred to as the Warren Buffett of India. He built his fortune by identifying undervalued stocks and holding on to them for the long haul. His success story is a testament to the power of value investing in the Indian context. Now, here's an intriguing fact. Studies have shown that value stocks have outperformed growth stocks over the long term. In fact, from 1926 to 2020, value stocks delivered an average annual return of about 12.4%, compared to 9.9% for growth stocks. This statistic highlights the potential of value investing, especially for those willing to do their homework and be patient. So, if you're a beginner in the Indian market, consider adopting a value investing mindset. Look for companies with strong fundamentals that are trading below their intrinsic value. It's not just about finding a bargain. It's about investing in quality businesses that can grow over time. Remember, investing is a marathon, not a sprint. By focusing on value, you're setting yourself up for long-term success. Value investing is a strategy that revolves around buying stocks that are undervalued compared to their intrinsic value. Intrinsic value is essentially what a company is truly worth, based on fundamentals like earnings, dividends, and growth potential. For instance, let's take a look at Infosys. If you analyze its earnings and growth prospects, you might find that its stock is trading at a lower price than what its future cash flows suggest. This discrepancy presents an opportunity for value investors. Now, let's talk about the margin of safety. This principle is about ensuring that you're not just buying a stock at a good price, but at a price that provides a cushion against errors in your analysis. Imagine you determine that Infosys has an intrinsic value of 1,000 rupees per share. If you can buy it for 800 rupees, you have a margin of safety of 200 rupees. This buffer protects you from unforeseen market fluctuations or mistakes in your valuation. It's like having a safety net when you're walking a tightrope. Next is the long-term focus. Value investing isn't about quick gains. It's about patience and discipline. Take the example of HDFC Bank. If you had invested in HDFC Bank a decade ago, you would have seen its stock price grow significantly, despite short-term volatility. The key is to hold on to your investments through market ups and downs, trusting that the underlying value will eventually be recognized by the market. In India, we've seen many value investors thrive by sticking to these principles. Rakesh Jhunjhunwala, often referred to as the Warren Buffett of India, built his wealth by identifying undervalued stocks and holding them for the long haul. His investment in Titan Company is a prime example. He recognized its potential early on and held on to it, reaping the rewards as the company grew. To sum it up, value investing is about understanding intrinsic value, ensuring a margin of safety, and maintaining a long-term perspective. By applying these principles, you can navigate the stock market with confidence and potentially achieve substantial returns. It's not just about picking stocks. It's about cultivating a mindset that values patience, analysis, and a deep understanding of the companies you invest in. When it comes to investing, Warren Buffett has a straightforward approach that anyone can learn from. The first step in his process is to focus on businesses he understands. This means he doesn't just throw money at any stock that looks good on paper. Instead, He invests in industries where he can predict future performance. Whether it's soft drinks or insurance, he sticks to what he knows. This is crucial because if you can't grasp how a business operates, how can you assess its potential? Next, Buffett looks for companies with a strong economic moat. What does that mean? Think of a moat as a protective barrier that keeps competitors at bay. This could be brand loyalty, like Coca-Cola, or a unique cost structure that allows a company to produce goods more efficiently than its rivals. A strong moat means a company can maintain its market position and profitability over time, which is exactly what Buffett wants. Then comes the financial analysis. Buffett dives deep into the numbers. He's particularly interested in return on equity, or ROE, which measures how effectively a company uses its capital to generate profits. He also looks for consistent free cash flow, which indicates that a company is generating more cash than it needs to operate. Low debt is another key factor. A company with manageable debt levels is less vulnerable to economic downturns. Finally, Buffett emphasizes the importance of paying a fair price for a stock based on its intrinsic value. He calculates this value by estimating future cash flows and determining what the business is truly worth. The goal is to buy when the stock is trading below this intrinsic value. This disciplined approach helps him avoid overpaying and ensures he's investing in solid companies at the right price. By following these steps, investing in what you understand, seeking out strong economic moats, analyzing financial strength, and paying a fair price, Buffett has built a legendary investment career. It's a method that emphasizes patience, knowledge, and a keen eye for value.
Value investing often gets a bad rap, and it's time to set the record straight. One of the biggest misconceptions is that cheap stocks are automatically value stocks. Just because a stock is trading at a low price doesn't mean it's a good buy. In fact, it could be a red flag. A low price might indicate that the market has lost faith in the company's fundamentals. It's crucial to dig deeper and assess whether the company has a solid business model, strong management, and a competitive edge. Now let's talk about the risks involved. One of the most significant dangers is mistaking a fundamentally weak company for an undervalued gem. It's easy to get lured in by a low price, but if the company is struggling with debt, declining sales, or poor management, you could be throwing your money down the drain. Remember, a stock can be cheap for a reason. Emotional discipline is another critical aspect of value investing. The market is volatile, and when prices drop, it's easy to panic. You might feel the urge to sell off your investments, but that's often the worst thing you can do. Value investing requires a long-term perspective. You have to trust your research and stay the course, even when the market is throwing tantrums. Staying disciplined means sticking to your investment thesis and not letting fear dictate your decisions. It's about having the confidence to hold on to your investments when everyone else is running for the hills. In summary, value investing is not just about finding cheap stocks. It's about finding quality companies that are temporarily undervalued. Avoid the trap of thinking low price equals value. And remember to keep your emotions in check during market fluctuations. With the right approach, value investing can be a rewarding strategy, but it requires diligence, patience, and a clear understanding of the risks involved.